Hi everyone, my name is Robin Speziale and I'm the national best-selling author of Market Masters. You can pick up my book, Market Masters, at your favorite bookstore or online at amazon.com or amazon.ca. Alright, so in this video I'll be talking about part 3 of my series on all my rules on investing in stocks. Okay, so because this is part 3, if you haven't listened to part 1 or part 2, please do listen to those first because we build on everything here. But I'm assuming the majority of you have listened to part 1 and 2. So, here's part 3. So in part 3, I'm going to be going over rules 51 through 72, and then that's a complete wrap up. Okay, so rule 51 on investing in stocks. I verify net accumulation in the stock by checking its accumulation distribution. That's the indicator, accumulation/distribution, on stockcharts.com. If the accumulation distribution is rising, along with the other indicator, which is on balance volume, especially in a stock that's been consolidating or trading flat, then that's a really good sign. I want other people buying and accumulating the stocks that I invest in too. It's all about demand. Rule 52. I do a new scan of North American stock markets, the TSX, the Venture, New York Stock Exchange, and NASDAQ every 3 months for new issues, IPOs. Also, some stocks appear in my filter for the very first time because they finally surpassed the metric benchmark, like return on capital. That way, I'm always on top of the market. All right, let's go to rule 53. I'll use leverage, or what other people call margin, in my portfolio, but I won't let debt surpass 20% of my portfolio's total value. 54. When I sell a declining stock on the basis that my original investment thesis has been invalidated, I'll invest those proceeds into one of my winners. The winners can make up for the losses and then some. Number 55. There's no such thing as passive investing if you're a stock picker. Seriously, I'm checking my portfolio on a daily basis. If I wanted to buy and forget, I'd cash out all my money into an S&P 500 index fund or an ETF. But that also means accepting those index-like returns. All right, number 56. Losing money has been the best lesson for me. I know what to avoid now, companies and management teams that destroy shareholder value. And with experience, I can more quickly identify and screen out those bad companies. It's surprising how many companies are superb at capital destruction. But I also study other people's mistakes too. It's cheaper. That includes mistakes by hedge fund managers and other smart money. Nobody's right all the time. As James Altucher says, the investors and hedge fund managers who are successful all of the time are probably criminals. That is, insider trading, are about to lose everything. But it's when investors get lost in a story stock where there's really no excuse. A great example is Teminco. Teminco was a hot story stock because it operated in the green technology sector, selling silicon to solar energy manufacturers. The idea was you could profit from the future surge in green technology by investing in Teminco, making you an instant millionaire, quote unquote. As a result, Teminco stock rose giddily from 33 cents per share in 2006 to its all-time high of $34 per share in 2008. Indeed, Teminco's stock return was astronomical. Then, from its 2008 peak of $34, Teminco declined all the way to 50 cents, okay? So it shot to the moon and then came all the way back to Earth. It declared bankruptcy in 2012. Okay, what went wrong with Teminco? As its stock price shot up to the sun, Teminco's earnings were deteriorating. 2006, minus 33 cents earnings per share. Next year, negative 20 cents earnings per share. Next year, negative 9 cents earnings per share. 2009, negative 83 cents earnings per share. Wow. Simply, investors became enchanted with Teminco's story, not their financials. Not all stories have happy endings, as we know. All right, rule 57. Think about all the assets, intangible and tangible, that a company owns, and not only each asset's cash flow generating ability now, but its ability to generate cash flow in the future. Having a lot of assets in the balance sheet doesn't mean anything if the company doesn't continually generate a high return on those assets for shareholders. I love companies with wonderful assets like Disney. The worst management teams buy bad assets through acquisitions at too high a price and then write off their mistakes, the bad assets, later. Management needs to be good stewards of capital for their shareholders and, acquiring good businesses that complement and grow their core business. Number 58, I go to stockcharts.com on a daily basis and check stockcharts.com on a daily basis and check the predefined scan section to monitor the stocks hitting 52-week highs. Go to Google, type in stock charts, predefined scans, okay? And then click on 52-week highs. If I see companies hitting new 52-week highs, I conduct further research and invest based on my aforementioned criteria. Why? Because that 52-week breakthrough price momentum is fueled by high demand, in that investors and institutions are just buying more and more shares. Similarly, stocks that finally break out of a consolidation phase or flatline are interesting to consider. For example, take a look at Alphabet's stock chart, which is Google. It traded in a flat range from the beginning of 2014 through mid-2015 and then broke out on stellar earnings results in July 2015, surging, get this, from $550 per share to $1,000 per share in 2017, doubling its market capitalization in just 2 short years. That's a 35% compound rate of return. In his book, How I Made $2 Million in the Stock Market, Nicholas Darvis documents how he turned $10,000 into $2.4 million in just 18 months during the 1957 to 58 bull market, using what he calls his box theory, which is based on monitoring price consolidations through a stock's rise. Darvis actively mapped a stock's price trend into a series of boxes. When the stock price was confined in a box, in other words, trading range bound, or in consolidation, right, flatlined, he waited and then bought when the price rose up of the box. He would invest more money every time the stock's price rose out and up of a new box, indicating new and established highs, and he simultaneously set a stop loss just under this new stock price. Number 59, I never say I missed out on that stock if I see it's gone up 500% in 5 years, for example, especially if it's a small cap or mid cap company, because I know that those great companies can compound many times more. Plus, they're still small. I never say it's too expensive, so I won't buy the stock after simply looking at its price to earnings ratio and nothing more, as we talked about before. It's all about growth. Rule 60, I don't quickly overlook companies that aren't generating a profit. They may be the next winners in the market. Amazon, for example, by the time Amazon started to generate a consistent profit, it had already become a $400 billion plus company, compounding many times over and making their loyal shareholders incredibly wealthy. Number 61, when I hear that there's a change of management in a company, it makes me take a second look, especially if I skipped over the company in the past, because the new management may be better operators and capital allocators. Number 62, I avoid companies that only grow through unsustainable and manufactured inorganic growth, like acquisitions fueled by debt. I completely ignore these, only acquisitive companies, because once debt or acquisition opportunities dry up, and often it's both, the stock will fall straight to the ground for value investors to scoop up. Acquiring companies and doing just that isn't a business strategy, it's a scheme. Rule 63. I learn about how successful investors think, their framework on why and how they pick stocks. You can read my book, Market Masters, and The Money Train, Market Wizards, or One Up on Wall Street to get into the minds of top investors. Rule 64. There is little spread to be made in merger arbitrage these days because of high frequency trading and easily accessible information. And when there is a juicy spread, the takeover could very well fall through. Take a look at the failed Ontario Teachers Pension Plan and Bell Canada takeover case. Investors in that merger arbitrage play got crushed fast on a deal that seemed like a sure thing. Sure, I'd rather conduct my own research and invest in small cap companies that could soon be taken over. They're speculative takeovers. For example, I purchased shares in Rona, speculating that Lowe's would return to attempt another takeover, having been blocked the first time. Lowe's did and succeeded in their second takeover attempt, sending Rona's stock up 100% in one day. Nice payday for me and worth the small amount of weight. Rule 65. I've come to realize that the market is largely psychologically driven. John Maynard Keynes described the stock market as a Keynesian beauty contest, where it's not a case of choosing those faces that to the best of one's judgment are really the prettiest, nor even those of the average opinion genuinely thinks the prettiest. We have reached the third degree where we devote our intelligences to anticipating what average opinion expects the average opinion to be. End quote. This beauty contest can be demonstrated in what I'll coin in an homage to the Nifty 50, the Sexy Six: Facebook, Apple, Alphabet, Netflix, Tesla, and Amazon. 66. I compare my long ideas, the stocks I want to buy, with their current short positions as a percentage of float, and the accumulating analyses by prominent short sellers. I also want to take into account the reasons why others would want to short a stock. In other words, bet that it will fall in price. For instance, investors who were long home capital stock would have done themselves a favor would have done themselves a favor by reading what prominent American short seller Mark Cohedas had to say about the company. While it's certainly hard to sell when a stock has had a remarkable track record, like in Home Capital's case, high return on capital, stellar price performance, one has to play devil's advocate to be successful over the long term. I don't just complacently say, how could anything ever go wrong? Look at the stock chart. It's a great business. Take a look at what Mark Cohedas, that short seller, says or thinks before he shorts a company. So Mark said, I never, ever, ever get involved in what I would call an open-ended situation. I have avoided pie-in-the-sky names. To use an analogy, I'm not interested in climbing into a tree and wrestling the jaguar out of the tree. I'm interested in someone shooting the jaguar out of the tree, and then I'll go cut the thing apart once it hits the ground. Instead of open-ended situations, I like to short complete pieces of garbage with fraudulent management and horrifically bad balance sheets. I look for change. I look for, if this goes away tomorrow, this company goes away tomorrow, will anyone miss them? What do they do well? All right, so rule 67. Usually the media headlines, like the death of equities or sell Canada, are most depressing exactly before the market starts to turn up. Again, after a recession, bear market, or correction. That makes for a great buying opportunity, which is why I keep cash on hand and, of course, still read news headlines to try to time the bottom. Here's an example. In Canada, on January 20th, 2016, Maclean's published their feature article called Assume the Crash Position. How far will the stock market fall? Canada's stock market has suffered through a lost decade of returns. Why the bad times for Canadian investors could continue. This is what Maclean's magazine had to say. The glory days for Canada's stock market when the S&P TSX could be relied upon to outperform the S&P 500, as it did immediately following the financial crisis, are as good as dead. With global markets now faltering too, Canadian investors are left wondering just how bad things will get. The outlook appears to be getting worse, not better. Well, just weeks later, in February 2016, Canada's stock markets, the TSX and Venture Exchange, started to honestly rocket upwards, surpassing other markets around the world. This reversal reminded me of what Bob Dylan said in his song, "The times they are changing. For the loser now will be later to win." And of course, Warren Buffett's adage, we should all know very well, which is to be fearful when others are greedy, and greedy when others are fearful. Similarly, in August 1979, the issue of Business Week, the cover story heralded the death of equities. The introduction stated, the masses long ago switched from stocks to investments having higher yields and more protection from inflation. Now the pension funds, the market's last hope, have won permission to quit stocks and bonds for real estate, futures, gold, and even diamonds. The death of equities looks like an almost permanent condition, reversible someday, but not soon, end quote. I'm sure you can guess what happened next. Okay, number 68. If I'm buying stocks and I see that other small cap funds or hedge funds are buying too, that gives me some validation, but it doesn't mean it'll work out. Some may choose to ride the coattails, meaning that they purposely buy what top investors buy in the stock market. Bill Ackman, billionaire hedge fund manager of Pershing Square and Market Masters, my book, said, you can't necessarily buy at the top price, but once these hedge fund managers announce the investment they've made, you can invest in it alongside them. And oftentimes, stocks don't go straight up. There's an opportunity to buy it again at cheaper prices. End quote. Some of the funds that I follow, which also invest in small mid-cap stocks, are Turtle Creek Asset Management, Pender Funds, Giverny Capital, Donville Kent Asset Management, J.C. Clark Adelaide Trust, and Moyer New Canada Fund. And you can validate U.S. stocks with these top investors' funds through their 13F filings in Whale Wisdom, Dalal Street, Third Point, Value Act, Arlington, Accra Capital Management, Tweedy Brown, Trian, Omega, Wedgwood SQ, and Pershing Square. I also find analysts like Jerry Wimmer. My portfolio has some overlap with these above funds, but I outright don't copy their picks. I conduct my own research. Rule 69, there's always tail risk. Someday when you're not expecting, some event will rock the stock market, in a bad way. It'll send stock prices crashing, but I'll only know about it after the fact. I guess I'm not all-knowing after all. I don't worry about things that I can't control. I control risk by holding great stocks and managing what I can in my portfolio. Here's some ways that investors can control risk. Keep cash on hand, buy puts like S&P 500, and set stop losses on individual stocks. Number 70, I don't rush into an initial public offering, an IPO, the first day that it issues in the stock market. The problem is that IPOs are released to the retail investor only after institutions have claimed blocks of shares for themselves at more attractive prices. Look what happened to Facebook. Its stock dropped considerably after IPO day from $38 to $19 per share. That's around minus 50% decline, but then flatlined through most of 2013 before breaking out and then going on a winning streak from $25 per share in 2013 to $150 per share in 2017, achieving a 600% return for its shareholders. The lesson here is to keep IPOs on your watch list and monitor for at least the first 6 months before you can invest in them. There's no rush. Tesla flatlined after its IPO in 2010 for 3 years, trading range-bound between $17 and $25 per share before it broke out in 2013, going from $25 per share to $310 per share. That's achieving a 12-bagger status in just 4 short years. And at only $50 billion market capitalization in 2017, I wouldn't be surprised to see that Tesla doubles again to $100 billion market cap as it grows its business, which now includes electric cars as well as Powerwalls and consumer solar panels. Okay, so Rule 71, spinoffs, those subsidiaries, for example, Yum Brands, which owns KFC, Taco Bell, and Pizza Hut, that got spun off from parent company PepsiCo, are very interesting because they're already proven businesses that can grow larger on the public equity market as an independent company. And sometimes it takes activist investors like Bill Ackman to push a company's board of directors to spin off subsidiaries and unlock value, as he did with Tim Horton's spinoff from Wendy's International. In Market Masters, my book, Ackman said, if there's one business making $2 billion and another business or another subsidiary losing $1 billion, people look at it and say, oh, it's got $1 billion of earnings. That's not the right way to think about it in most cases. Now, however, as in IPOs, there's usually a cleansing period with spin-offs where existing shareholders of the parent company receiving the spun-off stock in the new company may sell that new stock, setting the price down for some time. Take a look at PayPal, which was spun off from eBay. For 2 years, PayPal stock was under selling pressure as it traded range-bound around $40 per share before breaking out in 2017. Okay, the last rule, Rule 72. The stock market exists to help companies raise capital, grow, and be successful. Why would I ever invest in bad companies that don't grow? That's what value investors do, or at least try. But that's not why the market exists. Remember, one of Warren Buffett's and Benjamin Graham's best investments, Geico, was a growth stock. How ironic for two value investors to invest in a growth company. The great blog Base at Investing documented that Graham invested nearly 25% of his partner capital into Geico in 1948, acquiring 50% of the growing enterprise for the small sum of $712,000. This would eventually grow to $400 million 25 years later. That is a 500 bagger. Further, Benjamin Graham, the father of value investing, conceded later in his career that value investing wasn't what it used to be. Graham saying, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities." All right, guys. Well, thanks for listening to part 3 of my 3-part series on my rules on investing in stocks. If you haven't listened to part 1 and 2, please go to YouTube. You can find those on my channel. All these rules are in my free book, Capital Compounders. Find my email in the description to this video. Email me. I'll send you that book for free. It's PDF. Okay, thanks and talk soon.